What's up, my financially woke fam? It's your favorite slightly cynical, always spilling the tea Gen Z analyst, and today we're diving deep into a topic that makes 99% of people sweat bullets and 1% of people pop champagne: recessions. Yeah, you heard me. Recessions. While everyone else is busy doom scrolling and watching their portfolios bleed out like a forgotten TikTok trend, the truly smart money isn't just surviving, they're actively profiting. Like, seriously, generational wealth building levels of profit. And today, I'm going to pull back the curtain on their savage playbook. This isn't just about not losing, it's about winning, big time. So, buckle up, grab your overpriced oat latte, and let's get into it. Hashtag Section 1, The Great Panic versus The Great Opportunity. Alright, let's start with a vibe check. When the economy starts doing the limbo, going lower and lower, what's the typical reaction? Panic, right? News channels are screaming about job losses, inflation, market crashes. Your boomer relatives are reminiscing about '08, and your friends are debating whether to sell their Dogecoin or their kidneys. It's a whole thing. And why do most people lose? Because they act on emotion. Fear and greed are the two oldest tricks in the financial markets book, and during a recession, fear takes the main stage. People sell low, precisely when they should be buying. They listen to the noise instead of reading the signals. They treat their investments like a hot potato, rather than a long-term strategy. But here's the tea: smart investors, they love a good recession. Not because they're sociopaths, mostly, but because they understand that volatility creates opportunity. Think about it, when everyone else is dumping their assets, what happens to prices? They plummet. And what's the golden rule of investing? Buy low, sell high. Recessions are literally a giant sale sign slapped across the entire market. It's like Black Friday for billionaires, except you can join in if you know the secret handshake. Hashtag Section 2, Understanding the Recession Rhythm, it's not a black swan. Okay, before you start throwing your life savings into meme stocks during the next downturn, we need to understand something fundamental: recessions aren't random acts of economic terrorism. They are a feature, not a bug, of market cycles. They're predictable, if you know what to look for. What causes them? Usually, a cocktail of things: the Fed hiking interest rates to cool down inflation, making borrowing expensive, slowing growth, bursting asset bubbles, tech, housing, NFTs, you name it, supply chain shocks, geopolitical drama, or simply a massive drop in consumer confidence. It's rarely one thing, it's usually a domino effect. The biggest mistake? Believing it's different this time. Spoiler alert, it rarely is. Economic principles tend to hold up. Human psychology always holds up. So, instead of praying it away, you prepare for it. How do smart investors see it coming? They're watching the macroeconomic indicators like hawks watching a dropped French fry. We're talking about the inverted yield curve when short-term treasury bonds yield more than long-term ones. Historically, a pretty reliable predictor. Purchasing Managers Index, PMI signals contraction or expansion in manufacturing and services. Consumer sentiment Are people feeling rich and spending, or are they tightening their belts? Unemployment claims A rising trend is a red flag. Inflation data, interest rate decisions The Fed's moves are crucial. They're not waiting for CNBC to confirm the recession, they're seeing the writing on the wall months in advance, making their moves while everyone else is still debating avocado toast prices. Hashtag Section 3, The Smart Money Playbook, Pre-Recession Prep, the Glow-Up Phase. This is where the magic starts. You don't wait for the fire to start to buy a fire extinguisher. You prep. This phase is about fortifying your financial bunker and loading your cannons. 1. Cash is king, or queen, or whatever you identify with. When asset prices are plummeting, you need liquidity to scoop up those sweet deals. Smart investors start building a hefty cash reserve, way beyond your emergency fund. This isn't sitting idle, it's a strategic war chest. High-yield savings accounts are your besties here. 2. Debt reduction is non-negotiable *, especially high-interest consumer debt. Credit card debt, personal loans, these things will eat you alive during an economic downturn. Slash them. The fewer liabilities you have, the more agile you are, and the less stress you carry when things get tight. 3. Defensive positioning *, shift your portfolio. Dump the speculative, highly volatile stuff that relies on frothy market sentiment. Move into sectors that are historically resilient during recessions: healthcare, people always get sick; utilities, people always need electricity; consumer staples, people always gotta eat, right? These are your financial bunkers. 4. Identify overvalued assets, and avoid them: those meme stocks, that overhyped tech company with no profits, that real estate market that's gone parabolic. Smart money is selling or shorting these, or at least staying far, far away. Don't be the last one holding the bag when the music stops. This isn't about perfectly timing the market, it's about being prepared for the inevitable. It's about being ready to play offense when everyone else is playing defense, or worse, just running away screaming. #### Section 4, the Smart Money Playbook, during the recession, the buying spree. Alright, the recession hits. Chaos reigns. Your news feed is a dumpster fire. This is where you put on your savage investor face. This is your moment. 1. Dollar cost averaging on steroids *, you've heard of DCA, right? Regular investments over time. During a recession, you amplify this. You're consistently buying quality assets at lower and lower prices. Imagine buying Bitcoin at $20,000, then $15,000, then $10,000. That's how you average down your cost basis beautifully. When the market recovers, your average entry price looks ridiculously good. 2. Value investing opportunities *, this is Warren Buffett's playground. Identify fundamentally strong companies that are temporarily beaten down by market sentiment, not by a permanent flaw in their business model. Companies with strong balance sheets, consistent profits, essential products/services, and a competitive moat. They're basically giving away Rolexes for the price of a Timex. You gotta have the conviction to buy when everyone else is freaking out. 3. Specific investment vehicles *. ETFs *, broad market index ETFs, like SPY or VOO, are great for diversified buying. Sector-specific ETFs for resilient industries, healthcare, utilities, or those poised for a strong post-recession rebound, clean energy, infrastructure. Individual stocks * for the more adventurous. Target blue-chip companies, dividend aristocrats, or innovative tech companies that are temporarily out of favor but have long-term growth potential. Think Apple at a discount, or Microsoft when its P/E ratio looks sane. Real estate, for the truly brave distressed properties, foreclosures. This requires more capital and research, but the returns can be insane if you know what you're doing and have the stomach for it. 4. Consider inverse ETFs or shorting, advanced maneuvers for those with a higher risk tolerance and understanding. Inverse ETFs profit when the market goes down. Shorting individual stocks means borrowing and selling shares, hoping to buy them back cheaper. This is not for beginners and can lead to unlimited losses, so proceed with extreme caution and only if you really know your stuff. It's like playing chess against a grandmaster, you better have a plan. Remember, the goal isn't to perfectly catch the bottom, nobody does. The goal is to accumulate high-quality assets at significantly reduced prices while the market is having its emotional meltdown. ### Section 5, the Smart Money Playbook, Post-Recession Recovery, the Flex Phase. Okay, the worst is over. The market has found its footing, the Fed is hinting at rate cuts, unemployment is peaking and starting to tick down. This is where the smart money starts to flex. 1. Identifying leading indicators of recovery *, you're looking for signs that the tide is turning. A sustained rebound in consumer confidence, manufacturing data picking up, the Fed easing monetary policy, and most importantly, the stock market typically bottoms before the economic data officially confirms the recovery. The market is forward-looking. 2. Shifting back to growth asterisk. As the economy stabilizes and begins to rebound, you start rotating out of your defensive plays and back into growth-oriented assets. Those tech stocks, discretionary consumer goods, and small caps that were crushed during the downturn. They often see the biggest bounce back. You're taking profits from your defensive positions and redeploying them into the next phase of growth. 3. Long-term vision, not quick flips asterisk. While some might try to time the absolute top of the post-recession rally, smart money is focused on the long game. They bought quality assets at a discount and are now letting compounding do its magic. They're not just looking for a quick 20% gain, they're aiming for 200%, 500% over the next decade. That's how generational wealth is built, by being patient and letting your investments mature. Section 6, Real Talk, Pitfalls and Mindset Mastery. Look, this isn't a get-rich-quick scheme. If it were, everyone would be doing it. Here's the raw truth. No crystal ball. You cannot perfectly predict the start or end of a recession, or the exact bottom of the market. Anyone who claims they can is selling something, and it's probably not good. Emotional control is paramount. This is probably the hardest part. Buying when everyone is selling takes serious mental fortitude. It requires ignoring the media hysteria, trusting your research, and sticking to your plan. If you're easily swayed by fear, this strategy will eat you alive. Risk management is your BFF. Don't bet the farm on one stock. Diversify. Understand that even quality companies can go bankrupt. Only invest what you can afford to lose, especially in volatile times. It's not easy money, it's smarter money. It requires research, patience, and a deep understanding of economic cycles and business fundamentals. This isn't for the faint of heart, but the rewards for those who master it are substantial. Recessions are scary, yes. They suck for a lot of people. But for those who prepare, who understand the game, and who have the courage to act when others are frozen in fear, they represent the single biggest wealth transfer events in history. It's literally the market redistributing wealth from the impatient to the patient, from the emotional to the rational. So, what's your move? Are you going to be one of the sheep panicking, or are you going to join the wolves feasting? The choice is yours. Start building your recession playbook now. Start saving that cash. Start learning those indicators. Because the next recession isn't a threat, it's an invitation to elevate your financial game. If you found this deep dive valuable, smash that like button, subscribe for more cynical wisdom, and hit the notification bell so you don't miss out on the next masterclass. Drop a comment below, what's your biggest fear about recessions, and what's your biggest takeaway from this video? Let's get that conversation going. Peace out, and stay savage.